how do we choose which projects we should do? Okay, we got a number of projects, lots and lots of choice out there. We only have so much money. What are we going to do? So we use what's called capital rationing. So business only has so much money to invest in projects, and the choices they have to make are the ones that they're going to support is based on dollars and cents. So if a project overcomes the first hurdle of proving its ability to make money, so it needs to make money, then we have to ask ourselves, is it the best possible project? So capital rationing is the process through which a limited capital budget is allocated between different projects in a way that maximizes the overall shareholder and wealth. In other words, we pick the best projects. That's effectively what it comes down to. So how do we do that? Well, first of all, we got to calculate the net present value of all the projects. And if they're greater than zero, their potential. That's the first hurdle. Then we calculate the net present value per dollar of investment. Okay, so how much per dollar of investment? What is the ratio? And we rank according to the highest net present value relative to the investment. And as we rank through them, we apply our capital budget limitations. So for example, we have 10 projects, but we only have enough money to beat the top five. That's effectively how that works. So capital rationing is the circumstances in which there's a limit to the total amount of capital funds we can spend, and we're just picking the best. So we got to calculate the net present value per dollar spent for each positive project and order projects from the highest to the lowest. So here is an example. Okay, let's take a look at number 2. Number 2 here, the investment community, or the investment committee of a company has identified the following 7 projects with positive net present value. So in other words, someone's done mechanicals on this. So this is a pretty easy thing if they've done this. So here's positive net present values. If the board of directors has $3 million to spend, what project should we do? Okay, so project 1, you'll see the initial investment is $1 million and the net present value is $600,000. Project 2, $180,000, $1.8 million investment, net present value of $324,000. Project 3, $750,000 is the initial investment, and net present value of $285,000. So we do this for each one of those. Okay, we have to do a little bit of assessment. So what we have to do is we say these are all positive, so they all have positive net present values, meaning they're all considered as feasible projects. The question is, which one should we choose if we only got $3 million? So what we would do is we assess the investment relative to the net present value. So let's take a look at the mechanics of it here. So here's project 1. Here's the investment. Here's the net present value. That divided by that will give what's called the yield, or 60%. In other words, the net present value is 60% of the initial investment. In the case of project 2, the initial investment is $1.8 million. The net present value is $324,000. That's a 0.18. In other words, net present value is 18% of the initial investment. The project 3, $750,000 versus $285,000, that's 38% of the initial. Project 4, $600,000, $2.7 million net present value, or sorry, $270,000 is net present value. That's 45% of the initial. The project 5, $450,000 is the investment, $113,000 is the output. That's about 19% of the net present value. Project 6, $150,000, $21,000, that's 14%. And project 7, $250,000 is the investment, and 20 is the present value, that's 8%. So those are our, now what we need to do is rank them. So project number 1 is 60% yield. Okay, that's the highest percentage yield. And you'll see that the next one is project 4, 45%, project 3, which is 38%. So effectively, we sort them in the order of the yield. So you can see project 1 is number 1. The total spent on that is $1 million of the $3 million budget. Project 4 is $600,000. So together, that's a total of $1.6 million spent. We got a $3 million budget, keep in mind. So we can do that. So we do project 4, seeing it's 45% yield. The next one is project 3, $750,000. So that's total $2.35 million spent. So that would be our next one. And then we have approximately $650,000 left. What can we spend it on? Well, the next highest project that we can do within our budget is number 5, and it's 18% return. So what we found is that we've gone up to $2.8 million of a $3 million budget. We can't do part of a project, so that's the next possible amount that we can get. And you can see here that we can only really do 4 of these projects, and 4 of them, though, will chew up $2.8 million, and they'll have a net present value. You can tally those up of 1.6, 2.35, 2.75, 2.8. So that's $2.8 million. We can't do number 2 because of the fact that we just don't have enough initial money to do that. So this capital rationing is the easiest thing we've done all year. It's just a matter of getting your head around it, okay? What we need to do is we're going to be given, or we need to calculate the initial investment. We have to look at our net present value and say, well, how much does it pay back? We get a ratio of what the net present value is relative to the investment, say 60%. And then we're going to have our list of projects, and we'll rank them in order of how valuable they are. We have a budget of how much we can spend, so we pull the amounts from the budget, pull the amounts until our budget is all spent or is near all spent, and then we can determine which projects we're going to do. So this is how this capital rationing works. If we want to take a look at that, let's take a look at number 1. So I just wanted to give you a few minutes now to look at number 1, okay? So again, we use the same principles again. We rank our projects, we look for the percentage rate of yield, and then we select the highest yield items up to our budget. Well, in terms of topic 3 then, topic 3 looks at comparing investment options. And again, we've really looked at this. There's nothing new here. We're just putting a little bit of a spin on what we already know. So if we look at comparing business investments, we got to think about how are we going to compare one with the other. So to compare investments for each option, okay, so we have several options. We want to calculate based on what's the net present value of the returns, what's the next net present value of the expenditures, and calculate net return. Exactly what we did in the first place. And select investment that has a higher net return. So it's pretty simple. We got a bunch of investments. We basically do a net present value calculation on each of them, and then we say which one's best. That's really what we're looking at here. So the best way to do this is to look at a simple example. And in this case, we'll look at example question number 4 here. And this is the type of scenario that you run into. And again, we're not doing anything new here. We're applying the same concepts, just applying it to a decision-making situation that is a little bit different. A small regional airline has narrowed down possible choices for its next passenger plane purchase to 2 possible alternatives. The Eagle model costs $600,000 and would have an estimated resale value of $100,000 after 7 years. The Albatross model has a $750,000 price and would have an estimated resale value of $300,000 after 7 years. So again, we got 2 different airplanes, 2 different costs and revenue structures from them. The annual operating profit for the Eagle would be $150,000. Because of its greater fuel efficiency and slightly higher seating capacity, the Albatross's annual profit is $190,000. Which plane should the airline purchase if the cost of capital is 6.5% in current dollars? What is the economic advantage of selecting the preferred alternative? So here we got basically a couple of different types of aircraft that we want to look at. We're looking at the cost of buying them, the initial purchase price, and then we're looking at the profitability or the money that is generate coming in. So what we really need to do is to figure out, well, what is the net cost of each airplane, and then let's compare the two using a 6.5% cost of capital. So let's take a look at it. We have, first of all, the Eagle. Let's take a look at Eagle, and that's a 6.5% cost of capital, which is an I value of 0.065. So the outflows are $600,000 has to go out now in order to pay for the plane. The resale value is $100,000 in 7 years at 6.5%. So we need to draw that back, and we ask, well, what is the net present value of $100,000 in 7 years? We do the math on it. We can calculate it to be $64,350. So $6 million airplane, a $600,000 airplane, less the $64,350 that we're going to get for resale, means that the airplane is really costing us $535,649.51. Okay, so that's the outflows. Now the inflows of buying the Eagle deals with how much money it can make, and it says that the annual operating profit is $150,000 for 7 years. So that's just an annuity for $150,000 for 7 years. We do the math on that, and that comes to $822,677.97 in. Okay, so there's 535 going out, 822.23 going in. So what is the net present value of that particular airplane? It's the difference between two of those amounts, which is $287.28. So that's good. Let's look at the Eagle. We say, yeah, the Eagle is a positive number. It's not a bad plane to buy, but let's look at it, compare it to the Albatross. So the Albatross got $650,000 going out that you need to pay for it with, and at the end when you sell, it's going to get $300,000 back. So we do the same basic calculation. $750,000 now is $750,000, $300,000 in 7 years at the current rate is $193. So the net cost of the airplane is $750,000 less the trade-in value currently, $195,300. So the net present outflow of buying that plane is $556,948. Okay, so that's how much you got going out. How much does it have going in? Well, it's making $190,000 a year for 7 years. We do the math on that at the prevailing interest rate, and that means it is a little over $1 million, just a little bit over $1 million coming in. So we need to compare. We have 556 going out, a little over $1 million coming in. The difference is $485,110.20. So that's the net present value of the Albatross, almost $500,000. Whereas the net present value of the Eagle, which is a less expensive aircraft, is just shy of $300,000. Again, the number itself doesn't matter. It's the decision making that comes from it. This is 300. This is about 500. Which one's bigger? Which one's better? This one here. So the Albatross would be the preferred aircraft. And we can simply deduct the difference between 485, 110.20, and 287.028. 46 to calculate how much is it worth to them. What's the difference? So you can see that is 287. That's 485. It's almost a couple $100,000 difference between the two in favor of the Albatross. So this is the type of thing that we need to look at in these types of problems. We're looking at being able to compare one with the other. So I just want to take a look at number 5, or have you take a look at number 5. Number 5 says, Carl Williams does custom wheat combining. He got a combine harvester in southern Alberta. He will purchase either a new Massey or a new John Deere combine to replace his old machine. The Massey combine costs $190,000 and the Deere costs $156,000. The trade-in values after 6 years would be $50,000 and $40,000 respectively, because the Massey cuts 18-foot swath and the Deere is only 15-foot swath. Carl estimates that his annual profit from the Massey will be 10% higher than the John Deere, which would be $70,000 for John Deere. The Massey equipment dealer will provide 100% financing at 7% per annum, and the dealer will approximately 100% financing will approve 100% financing at 6%. Which combine should he purchase? So we've got a number of things going on there. We've got the initial price difference. We got the initial, or not the initial, the end value difference, and we've got the cost of borrowing difference. So we need to make some decisions with regards to that by bringing things back to their net present value. So take a couple minutes to look at that. Okay, well, we'll look at this one. So here's what we basically need to do. So Carl Williams is looking at a couple of tractors. Let's look at the Deere first, or the Massey first. The Massey costs $190,000, so that's $190,000 going out, and it will be able to pull in $50,000 in 6 years because of the trade-in value. And the Massey cost is 7%. So if we did the present value on $50,000 at 7%, we would know how much that's worth in today's dollars, and that would come right off the 190 minus the present value of the 50,000 would give you an estimate of what the machine's going to cost. Same thing here. If we took the John Deere at 156, we know that in a few years' time it's going to be worth $40,000. Again, applying the interest rate that John Deere is using, 6%. We do the math on that. So here, for example, here is the slide. So 190,000 goes out on one, and the present value of the money coming in is 26,731 for a net present value cost $163,000 for the Massey. For the John Deere, going out, it's 156, and when it comes back in terms of resales, worth 133,401. Just make sure that is the John Deere now, because the Massey is 190 and the John is 156. Yep. Okay. So this would mean that the present value cost of one tractor compared to the other, it certainly looks like the Deere is a less expensive tractor. In terms of the revenue, however, $70,000 for 7 years, it's going to be $77,000 a year, which is 70 plus 10% more. So the one makes 10% more. So we do the math on that. That's $325,000 in revenue, and we do the math on the other tractor, and it's $304,000 in revenue. So we subtract our revenue minus our cost in both cases, and we get a difference between them. The difference between them is in favor of the John Deere tractor. So the John Deere tractor is the more valuable tractor based on the analysis. Again, this is the type of tools that you're going to use in order to make these decisions. Okay, any questions on that? Okay, topic 4 in this looks at the payback period. And the payback period is a pretty simple little calculation as well. And all we're trying to do there is how long does it take to pay an investment back? So the payback period is the number of years it takes to recover the initial investment in the investment that you made now. For example, if the initial capital investment is $600,000 and generates an annual profit of $100,000 for 10 years, the payback period is 6 years. And again, we're going to ignore the time value of money for these. So $600,000, $100,000 a year. In 6 years, it would crest to $600,000. The payback approach for investment selection has some shortcomings. Payback calculation ignores time value of money. Again, it's for the purposes of decision making more than anything, so that's rationale. The payback calculation ignores profit and residual value, and the maximum acceptable payback period is set by the business rather than business in a rather arbitrary manner. So in this particular case, we've got a simple problem. It's fairly straightforward to do this. The expected profits from a $52,000 investment are $8,000 a year. In year 1, $12,000 in each of the years 2 to 5. So $8,000 in year 1, $12,000 remaining years, and $6,000 after that, 6 and 7. What is the investment payback period? So we got $52,000 going out. We've got $8,000, $12,000, $12,000, $12,000, $12,000, $6,000, $6,000 coming in. All we need to be able to do is to be able to stack them up by one another. So we'll do something like this. So year 1 is 8, 12, 12, 12, 12, 6, 6. Again, no issue here, no consideration here for time value of money. So here's the cumulative: 8, 20, 32, 44, 56, 80, 62, 68. So we can see it accumulates here. How much did we spend? 52,000. So when does that spending, when do we match our spending? Well, somewhere between year at 4 and 5, 44 to 56. We could say that's about halfway. So basically it's 4.5 years to pay back. Very simple, straightforward analysis, not complicated at all. We just calculate the flow, calculate the accumulation of the flow. When does the accumulation of the flow meet up to or balance the expenditure? That's the payback period. Very simple analysis. Often credited with being too simple, but for the purposes of calculation, it is so simple it's not even funny. Finally, in this section, we're just looking at non-financial considerations in investment. We looked at financial stuff, but there's lots and lots of other non-financial considerations too. All you need to be aware of is that when businesses make decisions, they use this type of analysis that we've been looking at here. But again, there are other factors too that come into play. How important is the project? Is it bigger? Is it part of a larger project? Is it politically sensitive? Is it legally able to do? There's all kinds of issues that come into play. But for purposes of our math course, what we're primarily looking at is the financial ones. And this is the type of analysis that you'll be using for that. I invite you to look at some of the example problems that I haven't completed. The answers should be there in the video, so you'll see that.